Oh boy, oh boy, oh boy, look at that. It is still dark out as I address you this morning with my Dunkin' Donuts coffee. Today is Thursday, March 17th. It is happy St. Patrick's Day, so happy St. Patrick's to everybody out there that's celebrating. I am Kenny Polcari, your host of the party, and here's what's happening in the markets. Have been very, very exciting over the last couple of days. So what is it that you need to know? What is it that's going on, right? Jay did not surprise the markets, right, at all. He said what he said he was going to say, but he did signal that he is open to being more aggressive. Investors celebrating by taking stocks higher, as if this was new news, which is a little bit curious. Oil in retreat after its parabolic rise, but it is once again kissing $100 a barrel this morning. And break out the slow cooker because we're having the corned beef and cabbage for dinner this evening. Okay, so look. March 16th, 2022, reported by Bloomberg, taken from the presser at 2:30 p.m. yesterday. The Fed chief reported scant evidence of a downturn anytime soon, saying the probability of a recession in the next year is not particularly elevated. But if inflation doesn't respond as expected, then he reserves the right to become more aggressive. It kind of reminds me of that no need to worry, inflation's transitory commentary, like we got this under control, which is more reason to worry. Investors in markets celebrated the fact that the Fed finally made the first move after months and months of speculation, a move of many that are now expected in the months ahead. In fact, by the sounds of it, we can expect 6 more hikes of 25 basis points each for a total of 7 hikes in 2022, or 1.75%. And that means we can expect a hike at every meeting between now and the end of the year. May, June, July, September, November, and December. Note there are no meetings in April, August, and October, which only means that if inflation does not respond to these very gentle rate hikes, there's a possibility of hiking in an off month, which would signal desperation. So here is what I thought they should do and what they should have done out of the gate. They should say what they mean and then do what they say. He should have grabbed the bull by the horns and raised rates 50 basis points yesterday with the promise to raise them another 50 in May. That gets us up 1 full percent before the summer, which then leaves them 6 months to see how the economy reacts, allowing them then to hike 25 basis points at subsequent meetings if they want to be gentle. And that would take us to a total of 2.25% by the end of the year versus the 1.75% that he's promised. In either case, inflation continues to run hot at 8+%, and that's before the possibility of it running even hotter if the smaller, gentler hikes prove to be useless. Now look, I'm not being a Debbie Downer here, but the sense is we need to be more aggressive, and so many economists poll agreed that we are in for a hard landing. Read recession. The idea that the Fed can manage a soft landing is now out the window. They might have, had they begun this gentle rate increases in the summer of 2021. And by now we have already been at 1.25%, but no, it was really political last year. They didn't want to disrupt the roaring bull market of 2021. So they sat back. They ignored the warning signs. So now we are where we are. The new language anticipates ongoing rate hikes throughout the year, which means they're not going to let the midterm elections get in the way, which I find a little bit curious. In addition, they think they're also going to get another 1% increase in 2023, which would take us up to 2.75% at the end of 21 months. But the Fed didn't stop there. They also added that they expect to begin reducing their $9 trillion balance sheet at the next meeting, May 3rd and 4th, at the fastest pace ever. It is expected that they're going to reduce at the rate of between $75 and $100 billion a month. Prior to this, the fastest pace that they ever reduced the balance sheet was at about $50 billion per month, and that was back in 2018, 2019. Remember when he promised that it would be a 3-part move, right? He was going to stop the stimulus, then begin the rate hikes, and then attempt to reduce the balance sheet. Well, that went out the window and out the window fast because he's doing it all at the same time. Expected real GDP growth was downgraded from 4% to 2.8%, while the PCE inflation rate went from 2.6 to 4.3. That's his favorite inflation indicator. The PCE is expected to come in at 6.1% on March 31st and only expected to go higher in the months ahead. So 4.3, not so sure I think that's realistic by the end of the year, but let's see. Now look, this does not mean that you need to light your hair on fire and sell everything. In fact, I would slow down and consider that currently the economy is strong. Corporate profits are up and interest rates are still historically low by all standards, which makes stocks attractive. In any event, though, this move is long overdue. In fact, if it were me, it would have started, like I said, back in the summer of 2020. But alas, I'm not the Fed chair. And that's a good thing because they are way behind the eight ball. And my sense is that they're going to have to move more aggressively than his comments yesterday revealed. By the end of the day, the Dow added 520 points, or 1.5%. The S&P up 96, or 2.2%. The Nasdaq up 490 points, or 3.7%. The Russell up 62, or 3.1%. And the transports absolutely killed it, rising 855 points, or 5.5%. You can thank falling oil prices for that. We'll get to that in a minute. The excitement in the market's mostly caused by the smart logic algos that scrape the headlines looking for positive words versus negative. And when they find them, it is risk on, which means the buy-side algos go into overdrive while the sell-side algos cancel their offerings in line, leaving a vacuum in prices, forcing the buy-side algos to reach higher and higher, tripping over each other in an attempt to fill the orders. It is the contra of what we just experienced over the last 2 or 3 months on the downside. Remember, it's not like there are more buyers than sellers. They're not. There are equal number on both sides. It's just that on days like yesterday, the buyers become so aggressive that the sellers take advantage of their angst. The same way the buyers have taken advantage of the sellers' angst over the past 3 months, right? They withdraw their inline bids. They leave a vacuum and prices fall. The 10-year Treasury ended the day yielding 2.18%. The 30-year ended yielding 2.4%. Gold fell $20 to end the day at $19.09. Oil fell $1.40 to end the day at $95.04. The Bloomberg Commodity Index, the BCOM, fell by 1%, and so investors celebrated, thinking that inflation must be waning. Oh boy, really? Well, the administration did host a meeting of the top 20 TikTokers, all of whom were between 15 and 22 years old, and all of whom have followers of between 1 and 10 million people. They got them to try to sell the story to Americans that we can thank Vlad for all the higher prices. It's his fault. No one here at all is responsible for the $80 tank of gas or the $12 a pound ribeye. Never mind what's happened to milk, eggs, bread, cereal, chicken, pork, pasta, olive oil, ketchup, peanut butter, and jelly. Right? Are you getting the picture? The videos of these TikTokers attempting to explain complex economic theories to their followers is laughable, if not insulting. Apparently, the Bidens think that this age group is going to usher in another wave of Democrats in November of 22 and then again in November of 24. Well, unless they change the voting age to 12, that's probably unlikely, but I digress. So let's go back to the markets. While the talk lately has been about recession, note the plunge in stock prices over the past 3 months, you would not have noticed that yesterday. 9 of the 11 broad S&P sectors ended in the green. Utilities and energy were the two dogs, closing down 2%, closing down 0.2% and 0.5%. While tech surged by 3.25%, consumer discretionary up 3.4%, communications up 2.7%. It's necessary to note that those 3 sectors have gotten beaten up the most, having fallen better than 20% this year. And after the last couple of up days, each of those sectors have rallied back about 6.5% as bargain hunters go on a shopping spree, but still leaving them down about 14% year to date, remaining the underperformers for 2022 so far, but we're still early in the game. The short hedges are also got slammed on this 2-day rally, as you might expect. The dog ETF lost 3%, the S&H ETF lost 4.5%, and the PSQ, which was the NASDAQ short ETF, lost 7%. The triple levered SPXS, which is the S&P short, gave back 10%, while the SPXL, the long, gained the same 10%. Oil, which saw a spectacular parabolic rise between February 24th and March 7th, up 44%, has now given most of that back, falling 28% through yesterday. the rise due to the Russian invasion of Ukraine, and then all the hysteria created over the loss of supply and surging demand. And then the weakness being credited to the idea that Joey would be able to replace the lost oil by releasing millions of barrels out of the Strategic Petroleum Reserve, as well as the begging Iran and Venezuela to help a guy out, as well as China locking down two of their key manufacturing cities, bringing those cities once again to a halt, destroying demand. All baloney. Yesterday's weakness also being credited to an unexpected jump in U.S. crude stockpiles, as well as some scant signs of progress in peace talks. Yeah, okay, right. Maybe after he manages to completely destroy a country and take control. If anyone thinks that Vlad is now going to come to the table, they are mistaken, especially since Joey promised to supply Ukraine with more military supplies, stopping short of closing the skies as Zelensky begged for in his open appeal to Congress yesterday morning. This morning, the Kremlin reiterated their intent and made clear that they do not respect the U.S. or the Allies and will not stop until Ukraine surrenders. This morning, oil is trading up $4 or 4.5%, kissing $100 a barrel, after the International Energy Agency told us that we're going to lose 3 million barrels per day of Russian crude per the sanctions. Iran and Venezuela haven't confirmed yet if they're going to help Joey out, and Joey and his left-leaning party will not make drilling in the U.S. any easier, allowing us to be the energy-independent country that we were. But let's not go there right now, right? Because there's plenty of time to talk about that. U.S. futures are marching in place this morning, one day after the Fed changed the course of monetary policy, as investors digest all of this economic news. My good friend Stephanie Link telling us that we all know the Fed is behind the curve, but at least they're telling the market that they're trying to fix it. And while it's true, it is infuriating for Americans that knew this, that saw this months ago, leaving so many to ask, what were you thinking? At 6 a.m., the Dow futures are down 40, S&P is down 9, NASDAQ down 27, the Russell's down 4, right? So they're relatively, after yesterday's spectacular move higher, that's relatively flat. Eco data yesterday revealed that consumer confidence is falling. Retail sales, ex-autos and gas, fell by 0.4% versus the expected rise of 0.4%. Today we're going to get housing starts expected to be up 2.8%, while building permits are down 2.4%. Industrial production of up 0.5%, while capacity utilization is coming in at 77.9%, inching ever closer to that tipping point of 80%. Keep your eyes on that, because that suggests even more building inflationary pressures. European markets are lower this morning, but not by much. They're churning in place too, as investors there digest Jay's comments. The war in Ukraine continues to dominate the news, and the comments this morning are not helping. At 6 a.m., we see the whole region down about 0.3%. Bitcoin's trading at 40,600. Ethereum's trading at 2760, relatively in line, not making any major move. The S&P closed last night at 4357, up a whopping 95 points. It's exciting, yes, but doesn't suggest that the worst is over. No, not at all. We remain in the 4114, 4450 trading range. Remember, the S&P did suffer a death cross on Monday, and while we could see us rally to resistance at 4450, I would expect to see plenty of resistance if and when we got there. Look, remain awake. Don't get caught up into the excitement. Stick to the plan, and you will be okay. Give me a call to discuss. I'm happy to do that. Okay, what do we have for dinner today? Well, it is St. Patrick's Day, so what do you got? So what do you think? Corned beef and cabbage, right? And while I'm not Irish, I do love a good corned beef sandwich, right? Especially if you buy it in a New York City deli. Anyway, it's not complicated. You just boil everything and then you serve it with mustard and horseradish, right? You should do this in a slow cooker. Cooks for about 8 hours, but it's great. So for this, you need a large white onion, 4 large red potatoes, a bag of carrots, 4 cloves of garlic, 2 tablespoons of sugar, 2 tablespoons of vinegar, salt and pepper, water, beer, cabbage, and then 1 corned beef with the spice packet that it comes with. Put it all in the slow cooker, right? Cover it with water and 1 can of beer, right? So pour the beer in and then fill the rest with water so it's covered. And cook it for 8 hours. Once it's done, open it up, slice it and serve it. It's simple, and if it's done right, it is delicious, and you can make a great corned beef and cabbage sandwich. You could even make a Reuben, right? Russian style if you want. Take the corned beef and use the Thousand Island dressing and the Swiss cheese and grill it. Oh, God, if you grill it, it's even better. The cheese gets all melty. Oh, my God, delish. In any event, look, the sun is just starting to peek its head up here over the horizon, so the day's about to get started. In any event, take good care, and I'll see you in the morning.